Welcome to Sovrun, where we demystify the gears of the global economy. Today, we're cracking open the 3-2-1 crack spread. Ever notice that gas prices sometimes stay high, even when crude oil is getting cheaper? That's because of a hidden middleman. The refining margin, or what traders call the crack spread. Think of a refinery as a high-tech kitchen. The crack spread is the cooking fee left over after buying the raw ingredients, the crude oil, and selling the finished meals like gasoline and diesel. It's simply the value added by turning heavy sludge into fuel. The math is simple. For every 3 barrels of crude, a typical refinery makes 2 barrels of gasoline and 1 of diesel. If crude is $75, 3 barrels cost $225. Selling those finished products for $310.80 leaves $85.80 in profit, or about $28.60 per barrel. A healthy spread is around $15. To put that in perspective, while the S&P 500 usually targets 10% growth a year, these refining margins can swing by hundreds of percent in weeks. In 2022, the spread hit $60, making refining more profitable than ever before. In the summer of 2022, gas hit $5 a gallon, even though crude wasn't at an all-time record. Why? Because we ran out of kitchen space, refineries were at max capacity, which blew the spread wide open and spiked your costs at the pump. The spread is the real signal for energy giants like Valero or Marathon. Many people wrongly assume oil prices drive everything, but the crack spread is the pulse of the actual supply chain. It's the buffer between the ground and your car. The key takeaway? It's the margin that matters. This logic applies everywhere, from natural gas spark spreads to soybean crush spreads. It's all about the value of the conversion, not just the price of the ingredients. Follow Sovrun for more financial insights.